Good morning, everyone. Now, all the civil servants, students, the next today's class is financial markets. As a part of Indian economy lectures, on account of COVID-19, since we are not able to conduct classes uh, regularly, so we are trying our level best to complete the pending syllabus. So make sure that you listen to these videos and make sure that you also ask doubts if in case my classes or Devi's classes, whatever classes is exclusively designed for BRICS IAS study circle students. If in case other students would want to watch, there is no issue. You're welcome. But any doubts, please do respond positively so that we will be able to solve all your queries in this regard. This is a kind of revision classes. Might not be very in depth, but it will give you almost 90% of every concept that is required for you to prepare for UPSC prelims examination. Alright, now Indian finance, the moment you hear the word market, you actually think about a place where goods are sold and bought. There's nothing wrong in thinking like that, but when it comes to financial markets, then we have some in the regular market we find goods to be sold and bought, whereas in financial markets there are financial instruments to be sold and bought. Alright, so what is a financial market? Look at the first point clearly, everybody. So before you start listening to this class, please do ensure that you open the material and download this material. This material also separately I have sent it across to you, and download the material, keep it in hand, and take the pen and pencil and make sure that you keep underlining and studying. Just take it like a class only, don't take it like as if some video is posted, so let me find a time and show it. Whichever time you want to listen to this lecture, I have no issues, but make sure you please listen to this. So financial market is something where we transfer funds between investors. So the company, business organizations would want to have money. If any business organization would like to have money, how do they get it from? Where do they get it from, right? The first question comes, if I'm a businessman, I wish to mobilize money or funds, where do I get it from? So therefore there are two people basically. The people who have money, who would like to invest money, and the people who are doing business and they want money for business activity. So therefore the person who lends money, we will be calling that fellow as a lender. Maybe financial institutions are lending money, non-banking financial institutions are also lending money, and the person who's in need of money can be called as a borrower. So there are two people basically, right? The people who are willing to lend money, the people who are willing to borrow money. In between there's going to be a mediator. So it's not easy for a lender directly to go and lend money. Sometimes it's not easy for a borrower to go to the lender directly and borrow the money, right? Yes. So therefore you have investors who are investing money, you have got lenders who are lending money, you have got borrowers and users of the investments. So basically, second point, if you could see, it's a transmission mechanism between investors. The money is being transmitted, money is being transferred, funds are being transferred, which may be utilized for the business purposes. And the third point, if you could see, it has, that means financial market is a situation which actually ensures and facilitates money transfer from the lender and investor to the borrower who is in need of money. And the third point, if you could see, who will be there? Individual investors, financial institutions, financial intermediaries. Understood? They are linked with various communication channels through banking, financial institutions, and they keep lending, providing credit through credit. So if I'm a bank, I want to lend money, the best option is maybe when I lend money, I create something called loan agreement, right? If I'm a businessman, I want to raise money from people, there's an option you must have heard that I might issue share, I might issue bond, I might issue debenture, I might issue bill of exchange, I might issue promissory note. There are so many financial documents or instruments that are used as a security, right? All those instruments which are used to raise money, all those instruments or documents which are used to raise money. If I'm a company, I want money, I issue debenture. It's an acknowledgement of debt. So it's a proof, it's a certificate that is issued by company stating that we borrowed money from you. In future, if anything happens, you, on the basis of this certificate, can file a suit or enforce it in court of law. So there is a secured. That's why we call it as the instruments which are normally issued by financial institutions or companies to raise money will be called as financial instruments. An instrument in banking language is a document which is in writing through which we transfer rights or transfer money. We will see that about instruments, because I'm splitting this financial markets lecture into 3 parts. In 3 parts I'm going to cover it off. So this is the first part. So fourth point, if you could see, deals with financial instruments like bill of exchange, shares, debentures, bonds, etc., etc. Bill of exchange is normally issued by a trader when he wants money. So say for example it's like this: a seller sold goods to buyer doesn't have money, and seller draws the bill of exchange, send it to buyer for acceptance. I repeat, when seller is selling the goods, buyer doesn't have money, then seller draws a document called bill of exchange, and this bill of exchange will be sent across to buyer, and buyer will sign on the bill stating that yes, I accept to pay the money, and the bill which has been accepted will be sent across to seller, and seller can transfer this bill to anybody, and this bill is going to be paid within 90 days. Next we have something called share. You must have heard in my earlier lectures, and share is basically issued by companies to raise money, and debentures is an acknowledgement of debt. It's a kind of borrowing. Bonds will be issued by government institutions and government companies. Alright. Next, if you see the second one, functions of finance. So what do you mean by financial market? It's a market where we allow and facilitate transfer of funds from investors and lenders to the borrowers or the users who will use it in turn for business activities. So thereby in the market there's going to be something called in banking language liquidity available. When the money is available through this channel, we call it as liquidity availability. Alright. Next, functions of first point, you see, it facilitates the interaction between two people, that is investors and borrowers. And this market provides the information, pricing information. In the sense, in financial markets, obviously, when you issue debenture, the first important thing that comes is how much is the interest rate. When I think of borrowing money from the bank, the first thing comes into my mind, how much is the interest rate. In the financial market, basically, the interest rate play a key role. So that information is going to be provided by a financial market. The third important thing is it provides security dealings in financial assets. In the sense, financial market doesn't simply raise money, it will definitely ensure that there is a security if in case anything happens later, that is going to be used for legal dispute settlement. And financial market will ensure that there's an adequate liquidity in the market, which means adequate supply of money in the market, which will facilitate business activities to move on. Yeah. The next thing, if you see, low cost of transactions. When you go in general from money lenders, if you want to borrow money, that's going to be very costly. Interest rate is going to be more than 20%, 30%. So that will increase the cost of funds, and thereby cost of running a business will be very high. So therefore, financial market where there are a lot of participants, there's a heavy competition, numerous financial institutions, several options, shares are options, bonds as an option, debentures as an option, bills of exchange, promissory notes. There are so many options. All these options would definitely ensure that you have a free flow of liquidity, and the cost of funds will definitely decrease. Alright, the next one, quickly move on. Try to read this because I made this material very simple so that you will be able to understand clearly and in a simple way. So based on this, then I will start conducting exams, and on the BRICS portal in the next few days we are going to come up with the software, and we will try to take interactive sessions wherever it is possible. Then and there you can clear the doubt, because recording video lectures and you having doubts and typing on WhatsApp, etc., it won't be very effective. But don't worry, even in the live classes we will get them recorded. If you want to hear them again, once again we will send it to you. But I think interactive lectures would definitely make a lot of difference, that I will do that in a very short span of time. Classification of financial markets. Financial markets will be divided into two segments. One is money market, second thing is capital market. Money market deals with short-term funds, not more than maybe 2 to 5 years, or extremely sorry, maybe up to 1 year. Money market deals with short-term funds up to 1 year. Anything above 1 year will be dealt in long-term market, that is capital market. So money market is divided into two parts. One is financial market is divided into two parts. Money market, which deals with short-term funds, capital markets, which deals with long-term funds. Yes. Then money market deals with money market instruments. We have got something called call money. We do have something called treasury bills. About all these instruments in the next part 2 video I'm going to explain. Until then, you please understand, for the information sake, if in case there's a question in prelims that which of the following is an element or component of money market, you need to understand these 5 elements, that is call money, treasury bills, commercial papers, certificate of deposits, and trade bills. In other words, fifth one, we also call it as bills of exchange. So the question can be, money market deals with what? Short-term funds, usually up to 1 year. Capital market deals with what? Long-term funds, anything more than 1 year. So the instruments which are raised in money market will have to be paid within 1 year. That means if I had borrowed money in money market using any instrument like call money, treasury bill, commercial paper, certificate of deposits, or trade bills, etc., etc., all these things through which anybody has borrowed money should be repaying this within 1 year. We simply call it as short term. Then we have capital markets. Capital markets, I divide this into 2 segments. One is a securities market, second thing is non-securities market. Under securities market, we have got primary market and we have got secondary market. I repeat, capital market, we divide that into 2 parts, securities market and non-securities market. Securities market, we have got primary market. Simple example of security is share, bond, debenture. Clear? Shares, bonds, debentures will come under securities market. That means company issues shares, then company is there in security market. Alright. Under that we have got primary market. In simple language, if you want me to understand, if you want me to explain this, primary market is a situation where the investor buys securities directly from the company. And when company will issue a prospectus, an investor who would want to invest in that company will fill up the application form, will submit to company directly. That is prime. So when you buy for the first time from the company, you will be in primary market. We have got initial public offer, we have got book building process, we have got private placement, so on and so forth. In the other part of the video, I will cover them. And in the secondary market is nothing but stock exchange. That means when you buy directly from the company, you are in primary market. When you go to stock exchange and buy the shares from the existing shareholders, that is secondary market. You have got equity market, debt market, commodity market, futures, options. Again, secondary market is divided into 2 segments, that is spot market, forward market. Forward market has again 2 divisions, that is futures and options. Futures and options. In other words, we also call them as derivatives. Once again, capital market has 2 segments. Security segment, non-security segment. When I say securities, please do understand, in a simple language, I raise money through shares, debentures. Am I clear? So when you buy for the first time from the company, that is primary market. You're purchasing shares of the company from the company directly for the first time. When you buy shares in the stock market, you go to Mumbai Stock Exchange online and you nicely pick up somebody who's willing to sell shares and you buy from them, that is secondary market. So you can buy shares in 2 ways. One from the company directly, second thing from stock market. Clear? Next, under secondary market, we have got 2 things: spot market, forward market. Yes, we'll have a discussion on that, okay? Then forward market has 2 divisions, futures and options, which are otherwise called as derivatives. Again, there are 2 types of options. Options we have got 2 types, put option and call option. Once again, secondary market has 2. Spot, forward. Spot is on spot, immediate delivery of payments and instruments will be done. Forward, future. And futures we have got 2 again, futures and options. That means you will have an agreement today to purchase certain amount of quantity at certain price at certain date, but today you have an agreement. You have an agreement today to purchase securities at certain quantity, certain price in future. That is derivatives we have, right? Under that we have 2, futures, options or derivatives, right? Under that we have got 2, put option, call option. Have a basic knowledge first. If you don't have a basic knowledge, you will not be able to understand what exactly is the main concept, right? Next, Non-securities market, under capital market we have got mutual funds. You must have heard about mutual fund is a mechanism through which small savings will be mobilized, and that mobilized savings mutual fund will invest. In my earlier video you must have studied. If you did not watch, please do watch that. Mutual fund mobilizes money and invest that money in stock market. So the investors are basically small scale investors who are actually purchasing mutual funds. Just like company issues shares, mutual fund issues units. And mutual funds, under non-securities market we have got mutual fund, we have got fixed deposit, we have got savings deposit, we have got post office savings. So capital market has got two segments: securities market, non-securities market. Securities market has two segments: primary market, secondary market. Secondary market has two segments: spot market, forward market. Forward market has two segments: futures and options. Very important for prelims exam, please. So have these basics, and the elaborate discussion will be there about all these instruments in my next video. Yeah, the next one, move on to the next page. We have even insurance also comes under non-securities market. The next one, if you could see, money market. What is this? First point, as I said, it deals with short-term funds up to 1 year. Second one, it does not deal with cash or money as such, but simply provides market for credit instruments. That means money market lends money. It allows people to borrow money through bills of exchange, promissory note, commercial paper, treasury bills. Briefly, all these things I'm going to discuss in the next video, but as of now please understand second point. Like first point is what? Money market deals with short-term funds. That means the funds which are lent, borrowed will be recovered within how many years? 1 year. Clear? The second important thing is money market instruments. What instrument? When I borrow money, what will I issue? When I lend money, what will be created? Bills of exchange, promissory note, commercial paper, treasury bills. We will have a discussion, a clear-cut discussion on this. Let me first introduce this in the first video. And these instruments are close substitute to money. That means instead of money moving, instead of cash being moved from one person to another person, that means if you want to lend money, I can lend money to company taking something called bill of exchange or promissory note, commercial paper, treasury bills, etc. So like say for example, government wants money. Government issues a bill of exchange called treasury bill. So government issues this bill called treasury bill, and people will lend money to government. So money is kept in the form of what? Treasury bill. That is the thing. The next one. So these instruments obviously helps business units, organizations, governments to borrow money to meet their short-term requirements. So money market instruments are short-term. Money which is being raised in the money market will be paid off within 1 year. And the instruments are bill of exchange, promissory note, commercial paper, treasury bills. Alright. Okay. Who will participate? I've given clearly here. You can say business units will participate, companies will participate, governments will participate. And to cater to the needs of these people just for a short term, that is for 1 year. Yes, I know this is not a classroom class, so you might there's nothing wrong in taking a pause whenever you feel like any video, like lengthy videos. If that is more than 30 minutes, just put it on pause button and make sure that you relax and again continue, because leaving something in the preparation of IAS doesn't add anything for you. I'm telling you guys, you need to crush yourself a lot. You need to actually be very determined. That perseverance is very important. I'm telling you, please, if in case whenever you feel like bored, because this is a different way of teaching classes, it's not a natural way of teaching classes. It's obviously they won't be very effective as you expect a teacher talking to you right in front of you in the classroom. So make sure that you take a pause and continue hearing it, and never ever listen to this unless and until you have a pen and paper and underline and have the material in hand. Right? Next one. What are the money market components? In the sense, who will actually participate? See here, Indian money market consists of Reserve Bank of India as an apex bank, commercial banks. I mean, they lend money for what? Short term. Commercial banks lend money for short term. Cooperative banks lend money for short term, and other financial institutions. In this money market, who is actually regulatory body? Reserve Bank of India. That means who will monitor, control, regulate all the operations, interest rates, policies, rules, regulations, so on and so forth. And non-banking financial institutions like insurance companies like LIC, GIC, UTI, Unit Trust of India. These people mobilize a lot of money through insurance policies from public, and they have thousands and thousands of crores, and that money has to be repaid back to the people thereafter after a maturity. So these institutions are the major lenders in money market. Yeah, please do understand, they do participate in capital market, but in money market they regularly participate. Okay, then the capital market. Capital market, as I told you, this is a market where business units can raise money for what? Long term. Yes, and so it constitutes long-term borrowings from the banks, financial institutions, etc., foreign markets also. So basically, there are three securities which are very important. One is uh, shares, debentures, and bonds. Okay, companies issue shares, companies issues debentures, government organizations will issue bonds. Okay, securities market has again two important very segments. I repeat, securities market. So capital market, as it, you remember capital market, in this I covered something called capital market. You have two, securities market, non-securities market. So come back here, and if you could see capital market, types of capital markets you have here. So primary market and secondary market. As I said, when you buy shares directly from the company, while company issues a prospectus, you will submit an application, you will subscribe for the shares of the company directly from the company, that is primary market. But when you purchase shares in the stock exchange, which means you're not directly purchasing shares from the company, but you're purchasing shares from somebody who is in possession of the shares in the stock market, that is secondary market. Yes, primary market. See, now here I have given some points very clearly. Briefly, what is primary market? About the instruments we'll study in the next video. It consists of arrangements for procurement of long-term funds. Basically, in primary market, fresh issue of shares and debentures. For the first time when the company issues shares and debentures, we will deal with that. And the secondary market is basically what? Stock market, where the securities are already ready and you can go and buy from them. So stock exchange is nothing but a secondary market. Sale and purchase of different securities which are already issued, right? Yes. Now, if you could see secondary market or stock exchange, the functions of the stock is, sometimes you will have a question, which of the following is or is not the function of stock exchange. Alright, so the functions, if you could see, there is a stock exchange. I bought the share from Reliance company and I wanted money right now because the share value increased. Where will I sell it? I can't go back to the company and sell it, right? So what do? I will go to stock exchange. I will sell the share which I have at a higher rate if the rate is more, sometimes lower rate if the rate is less. So it provides a ready market facility for all those investors who have already invested in companies. Clear? So therefore, stock exchanges play a vital role in investments, mobilizing savings, capital formation, so on and so forth. So it acts as a barometer. That means if the stock exchange investments are increasing, it clearly tells us the amount of funds that are available in the country. That's why when the stock exchange index is increasing, it's a symbol that the investment has increased. And if it is going down, which clearly means the amount of investment is going down. So it's where it is actually acting as a barometer for the Indian economy. Stock exchanges provide many benefits to companies, investors as a whole. Companies can mobilize funds from stock exchange, and investors can go and trade their securities whenever they want to sell them at a higher rates. Then but they also suffer from limitations. Sometimes what happens is unnecessary speculation will be created. Though original share value will normally increase when the company's value increases, when the company profit increases, when the company's financial results are very good. But sometimes unnecessary speculation may be created, so you will definitely face a problem. So you need to be very cautious while investing in stock exchange. There are so many limitations also here, rumors and etc also will affect. There are operative stock exchanges in India. We have got 21 stock exchanges. Out of that, leading we have Bombay Stock Exchange, National Stock Exchange, Over the Counter Exchange of India. About all these three in the next video we'll discuss. And these are regulated stock exchanges are regulated by SEBI, Securities Exchange Board of India. It's an apex body to control all the stock exchanges. right? And a lot of documented procedure is there. I mean, you cannot simply invest money there. Everything is official, nothing is black, nothing is hidden, everything is very transparent when you invest in stock exchange. But nowadays, if you want to invest in stock exchange, you may have to open a demat account. So demat account rules, regulations, how is it created, etc., we'll see in the next video. So these are all general characteristics of what? Stock exchange. That is, stock exchange also we call it as what? Secondary market. Components of secondary market. Yes. First one, secondary market may we have spot market, forward market. Very simple language I have used. Please make sure that you understand this. What do I do in stock exchange? I sell my securities. What are actually securities? Which are in the form of shares, bonds and debentures. How did I get share? I gave money to company. Company sold a share to me. What do you mean by shareholder? I'm a member of the company. What is the benefit if I'm a member of the company? When company earns profit, company will give me return. How do you get return from the company? In the form of dividend. What is the dividend? It's a profit on the shares that I invested. What if I don't want to wait till company announces a dividend till the year end? Then I will go to stock exchange and see if the company value is increased, share value will go up. And I will suppose I bought share at 10 rupees, but in the market right now 100 rupees, 90 rupees profit, obviously I'll go and sell it off. So why do I go to stock exchange? Because I want to sell shares which I bought from the companies. Now understand, just a typical, if you don't convert this into general language, these terms will give you a lot of confusion, and this confusion continue forever, you will face problem. In stock exchange, what are we doing? We are selling stocks, means securities. Example, shares, bonds, debentures. Clear? So there are two things. Spot market. It's a market where when you buy shares, you will immediately deliver shares. Sorry, when you buy shares, you will get money immediately. You will get money immediately. You will deliver securities immediately. That is spot market. Contrary to this, under forward market, when you buy securities, means you are purchasing a share. When you are purchasing a share, you have to make a payment. You will make a payment at a future date. You will have an agreement today that you will make a payment, right? So, securities are traded for future delivery and payment is forward. Securities are traded immediate delivery and payment is spot. Clear? Yes. And under forward market, I said two, futures and options. About these two, futures and options, I will discuss in detail. Okay. So until then you understand, they are a part of forward market. Forward market means the securities that you bought will be given to you later date, and the money, if in case you are supposed to make a payment, it will be paid at a later date. Okay. But how many ever shares that you wish to buy? Suppose I want to buy 10 shares because I am afraid that price will increase. Currently price is 100 rupees, and if it goes up to 150 rupees, I might be losing, right? If I am interested in purchasing shares, what do? Since I am scared of increase in prices in future, I will have an agreement today. In that agreement, I mention these many shares I am going to buy, this much is the money I am going to pay at so and so date. So you have an agreement today about the future transaction. That is derivative. So in that derivative, obviously, when there is an agreement, in that agreement which is meant for future quantity and price, etc., you will definitely have two things: right, obligation. Clear? So options may, derivatives may, we have got two important things: the agreement that you have today to purchase certain quantity of shares at a future date. I mean, you agree that today's so and so prices, suppose today 100 rupees, you are expecting price will go up to 150 rupees. So what you do, instead of purchasing 100 rupees, though he will not, he wants some, because the seller is also expecting that the price will decrease. So there are two people. Buyer is expecting that future price will increase. Seller is expecting that price will decrease. 100 rupees share, if it decreases to 80 rupees, seller is going to incur loss. 100 rupees share, if it is increased to 120 rupees, buyer is going to incur loss. So it's better to have an agreement today which is amicable for both of them. That agreement can be a derivative, which means what? 100 rupees price today, they can have an agreement at 105 or 110. There ends the matter. So what are you deciding here? Quantity that you would like to buy and the price at which you would like to buy, but not the current price, but not what you expected. In between, they will finalize something. Brokers will play a key role in this. So in every agreement, an agreement to take shares, quantity of shares at certain price at certain date will be derivative. So you have a copy of agreement. In that copy of agreement, you'll have two things: rights and obligations. So one kind of agreement creates only right for you. One kind of agreement creates only a right to right to sell, right to purchase. There are two rights basically. If it is put option, you have a right to sell. Means you don't have an obligation. See the first one. It gives a right but not the obligation to sell. I have a right to sell. If I wish to, I will, but I don't have an obligation to sell. Whereas call option, I have a right to purchase. I have a right to purchase, but I'm not under the obligation of purchase. That means what? You have an agreement today. You have got put option, which means you have a right to sell. It is your prerogative. You have no obligation to sell. Why you don't sell? Because when it is profitable, when it is not at all profitable, you don't want to sell like this. Okay, in detail we'll have. So these are the two options. Please do understand that. Yes. Now overall, if you could see, all of you, money market, we are closing this small video, that is money market, capital market overall. And so in this video I focused only the basic glaring differences between money market and capital market. About money market instruments, capital market instruments, I'm going to have an elaborate discussion. Alright, money market, see, it deals with short-term funds. I told you short-term funds means up to how many years you can lend money, and that can be recovered within how many years? 1 year. Long term, anything more than 1 year. And in money market, what securities will? Treasury bills, commercial papers, bills of exchange, certificate of deposits. Clear? In capital market, what do you deal with? Shares, debentures, bonds, and government securities. Government securities are also called as treasury bills. Clear? Who are all participating in money market? Commercial banks will participate, non-banking, chit funds. And who is the regulatory of money market? Reserve Bank of India. Who will participate in this? Stockbrokers are there, underwriters are there, mutual funds are there, investors are there, financial institutions are there. Who will regulate capital market? SEBI, Securities Exchange Board of India. Very clear? If the question is who among the following, which of the following institution regulates money market? Reserve Bank of India. Which of the following regulates capital market? SEBI. Which of the following deals with only short term? Money market. Which of the following deals with only long term? That is capital market. Alright, I hope the basic introduction of financial market is very clear. Go through the material. Any doubts, please keep posting. Thank you so much. Have a nice day.